Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Through the Noise. Now there's been a lot of talk about data fog in financial markets, and interesting enough we've been having some awfully foggy weather here in Dubai the last few days as winter rolls in, and it's certainly been adding a new perspective to that term. This source of data fog, of course, is currently a key source of volatility in markets, but the key question is it temporary? To discuss that and more, I'm joined today by Heung, who's a senior investment strategist in the CIO office. So welcome, Ray. Let's jump right to the key question. This data fog resulting from the US government shutdown, how is that impacting our rate cut expectations?
Hey, Manpreet, thank you for having me. I think the data fog definitely has contributed to a lower probability of the cut of interest rate in December. If you look at the market implied probability, it's actually fall from almost a certainty prior to the October FOMC meeting to the current approximately 30%. The US also will not be reporting the non-farm payroll data for October anymore because of the Hodgkin statistical survey during the government shutdown. While the November non-farm payroll data will only be released on a delayed manner, and that is going to be delayed after the December FOMC meeting finished. So minutes from the FOMC meeting in October insofar, and also the fact speech since then, also show that members' view were quite divided. And all these are also driving lower the odds for a December cut. But we think that, the Fed will ultimately cut rate in the subsequent meetings, even if they skip the December one, as we continue to believe the job market will weaken from here. So during the Federal Reserve government shutdown, we saw private sector show falling job openings, slowing wage growth, and a surge in layoff announcement, which indicates the US job market is actually continuing to slow down. The delayed release of the September non-farm payroll number was better than expected, but we saw that revision of job as downward for earlier months, actually pointing to a slower overall trend of job creation, which is also consistent with the the showing from the private sector data. So we do believe the Fed will ultimately cut rates again by the end of first quarter 2026, even if it holds rates unchanged in the upcoming December meeting.
Thanks, Ray. I guess with that context, in your view, what's the implication for risky assets like equities in this scenario?
Thanks, Manpreet, again. I think the potential hold of interest rate in the next FOMC meeting because of the lack of key data, the still above target inflation in the macro side, plus more concern coming from the elevated valuation of the tech sector, will bring volatility to both the equity and bond markets. But having said that, I think on the bond side, we expect the weakening in job growth will force the hands of FOMC to deliver rate cuts by the end of first quarter 2026. We view that any rise in the US 10-year government bond yields towards the 4.25% due to any near-term uncertainty around the December policy meeting is very good opportunity to add high-quality bonds to lock in the still very good level of yields, and preferably buy bonds in the 5 to 7 years maturity bucket. And for equities, we think the recent announcement of NVIDIA earnings and strong forward guidance help ease another headwind facing equity lately, which is, the elevated equity valuation. And specifically, if we look at NVIDIA's guidance, it shows robust order books, earnings growth, and attractive profit margins for the semiconductor sector. And we believe these robust fundamentals will justify relatively high sector valuation. So this suggests to us that we should use any short-term pullback in equities in the US and also China tech sector to add exposure.
So on that point on China tech equities particularly, can you also maybe offer our listeners a bit of an overview of what we've learned from earnings in China equities, given we're also overweight China equities?
Sure. The China stock growth stock actually delivered pretty solid result in the third quarter of 2025, with the IT sector showing robust earnings growth at around 58%. And in contrast, if you look at the consumer discretionary sector, it's posed about 9% increase, while telecommunications services sector declined by 8%, which the both of these sectors underperformed the 12% rise in the broader MSCI China index. Of course, deflationary pressure and prolonged price competition have weighed down on margins too. There are some dampening of investor sentiment after the recent pullback in the global equities, but we think that we remain overweight on these sectors given, number one, if we're talking about policy tailwinds, the Chinese government anti-involution measures actually aim at curbing excessive price competition, and that shall bolster corporate margins. Secondly, on the tech investment cycle, there's ongoing capital expenditure in the innovation in AI across major technology stocks to achieve technological self-reliance. And third, looking at the valuation, Chinese tech stocks continue to trade at a discount relative to developed market peers. And looking ahead, the 42% increase in 12-month forward EPS growth for the Hang Seng Tech Index shall be providing a fairly solid foundation for continued valuation re-rating. Meanwhile, I think overall speaking, China's sustained property market downturn also raising the chance of more targeted stimulus, which could also boost sentiment a little bit further.
All right. I wanted to switch gears a little bit to Japan because we've obviously got news, pointing to the new government preparing a larger than expected stimulus. But in your view, where do the most interesting investment implications lie? Is it in stocks, bonds, or even the Japanese currency?
Yes, I think the potential larger than expected fiscal budget has caused long-term bond yield to spike already. If you look at the JGB 10 years, it rose to over 1.8%, which is a level not seen before the global financial crisis. But after all, it did retreat a little bit. We think the BOJ may intervene if the rise in yield becomes too aggressive, and the market is expecting rate hikes in the March 2026 meeting. We do see further steepening in the yield curve, and so little room to be bullish on long-term JGBs. Now, for equities, we think the earnings has been solid for the quarter three, driven by resilient corporate margins, and we also seeing constructive forward earnings outlook and ongoing improvement in the corporate governance in Japan's corporate universe. These are also factors that have been supporting the equity rallies. However, we're seeing increasing downside risk in the near term. For one, I think it's the escalating geopolitical tension with China, particularly through the potential loss of tourism revenue, and also there might be disruption from the supply chain. Secondly is obviously the evaluation side of the equation. Japan equities now appears less compelling, with the Nikkei 225 right now trading at around 1.5 standard deviation above its 5 years average. So we may see that as a limitation to the near-term potential upside. Looking at the FX side of the equation, and in particular focusing on dollar yen, the pair broke over 157 yen to the dollar, driven by the stronger US dollar and also the lingering dovishness in the Bank of Japan. However, we expect the dollar yen to be capped. Now, on the side of the US dollar strength, as I alluded to earlier, the market probably expecting the Fed to hold in the December rate cuts, but this will only give short-term support to the dollar as we view the weak job creation in the US will keep the dollar from strengthening much. On the Japan side of the equation, we expect the BOJ normalization to come eventually, with the market pricing in March currently, but there are also voices that the rate hike can come earlier. And also, not to forget, intervention is actually higher risk on the back of sharp moves in the exchange rate. And from a technical standpoint, I think 158 to 160 yen to the dollar is probably a significant midterm resistance zone. So we expect the dollar yen to consolidate within this band rather than breaking meaningfully higher.
All right. Well, thank you, Ray, for that detailed context on Japanese assets. I think that brings us to the end of time available today. So thank you for taking the time to speak to our listeners. If I can take the opportunity to summarize the top takeaways from our conversation, Number one, we may have an opportunity to add to our preferred equity markets, including the technology sector in the US, amid the recent data fog-driven volatility. Second, in China, some weak data, but that, of course, may be an opportunity to add to China tech and discretionary sectors, especially if there's stimulus in the pipeline. And third, dollar yen, potentially opportunity out of Japan, but we think that pair will remain range-bound. So thank you, listeners, for taking the time to dial in. We hope you enjoyed the podcast, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.